Welcome to Unlocking Global Investment Potential, Overcoming Home Country Bias, a webcast sponsored by Diamond Hill. Thank you for joining us today. I'm Laura Krieger, and I'm the editor-in-chief here at Vetify. I'll be your host for today's webcast. So we have a great conversation in store for you today. We're going to kick things off with a look at how home bias can limit an investment portfolio. We're going to explore attractively valued international businesses and then take an in-depth review of how active management shines in international allocations. But before I get to all of that, before I introduce my guests, we have a few housekeeping things we have to go over first. So first, we offer closed captions for our video webcasts. You want to turn these on or off? It's very easy. Just click that CC button you see on the bottom right of your media player window. Next, throughout this presentation, you'll have plenty of chances to ask us questions. We love questions. We want you to ask questions. So to do it, just type whatever you wanted to ask us into that Q&A box you see at the bottom right corner of your screen. We're going to save all the questions until the end and then try to answer as many as we can in the time remaining. We'll also periodically be asking you questions throughout the course of the webcast. We appreciate your participation in these polling questions, and we're going to share the results of those as we go. There's also a survey that you can complete at any point during this broadcast. You can find that in the widget underneath your media player window, or by clicking that clipboard icon that you see at the bottom of your screen. And in fact, in that survey are a few questions asking for your feedback on today's webcast, so we really appreciate your input and opinion on this one. Next, these slides, as well as a recording of today's presentation, are going to be made available to you on demand very shortly. You're going to get an email when that goes live. You can also download a copy of this presentation via that folder icon that you see at the bottom of your screen. You're actually going to find some more material from Diamond Hill in that folder, including a fact sheet for the Diamond Hill International Fund, insights about the risks and opportunities in global markets and how to seize opportunities beyond borders, and then more information about the Diamond Hill philosophy and process. One last thing, if you're looking to receive CE credits for this webcast, it's very easy. Just click on that certificate icon that you see at the bottom of your screen. Once you've completed everything you need to in order to get that credit, green check mark appears and you're good to go. All right, now it is time for me to introduce today's guests. I am delighted to be joined today by Krishna Mohanraj. He is a portfolio manager at Diamond Hill, where he is conducting deep fundamental analysis in the search for attractive opportunities in the global equities market. Now, Krishna and his team of global analysts, they look at a business's long-term intrinsic value and are very highly selective and in their examinations of stocks' relative attractivenesses and how they interact with other holdings at the portfolio level. I'm also excited to welcome Matt McLaughlin. He's a portfolio specialist at Diamond Hill, and he serves at the firm. He's been with the firm for about a year, so we have both of them on together. So this is going to be a great webcast. I'm really looking forward to this, and I'm going to hand the mic over to Krishna and Matt in just a second. Before we do, let's set the stage with our first polling question. Get that up on the screen there. And so the question is this: do you expect to increase or decrease your clients' allocations to non-US equities over the next 12 months? You can choose, I'm going to increase, I'm going to choose to decrease, or I'm not planning on making any change. So I'm giving you just a second or two to make your selection. I think that's probably been enough time. So let's see what the survey says here. Wow, it looks like most folks on this webcast, clear majority actually, planning to increase their allocations. But I'm also surprised to see that over a third of respondents here don't plan to make any changes at all. So Krishna, let me ask you, does this result surprise you at all, or is it in line with the sorts of conversations you're having with folks in the field?
Yeah, I think, first of all, thanks. Very excited to be here, and thanks for that introduction, Laura. I would say the result doesn't surprise me. I would say between Matt and I guess we have our task cut out to to present our case to the other third. So we'll see how it goes.
Well, we'll definitely see how it goes. Matt, I'm going to bring you in here. I know you have a couple of questions for Krishna.
Sure. Thanks, Laura, and thanks for having us today. Maybe we'll just go ahead and kick off the presentation because, I think kind of how what the question implies is that people are thinking about their international allocation. And I think part of the reason they're thinking about it is that we've basically had 15 years of outperformance of U.S. markets. Probably many of the advisors out there have clients that are in their prime earning years who have been hopefully saving diligently with their 401k and continue to put money in. But those clients have never really seen the international outperform U.S. markets. So I'll start off with just the question. Krishna, is that U.S. outperformance what we and advisors should expect going forward based on history, or does history contradict the last 15 years of U.S. outperformance?
Matt, let me start with the most important message. Now is as good a time as any to rethink allocations to international. As you said it, we've seen a long period of U.S. equity outperformance, and this outperformance, let's face it, has come from just a handful of stocks, right? So naturally, most investor portfolios right now are pretty heavyweight, this single theme. At the same time, you look outside the US, and that's what we do most of the time. There are significant opportunities for alpha. So really the question we should be asking is, why would we ignore non-US markets? Why give up a free lunch, right? So hopefully for the 1/3 who said there is no change, this conversation throughout, we can get across the point that there is opportunity left untapped in international markets, and how, as Diamond Hill, we are approaching this. The international opportunity is huge. Having a very, very selective approach is what we want to do and what we think makes the best sense when investing in something as big as international. So let's start with the context. Let's start with the provocative question that you raised. Should we even bother investing in international? It's a fair question given how well the market has done in decade plus now. And many investors at this point, especially retail investors, they find it hard to think beyond the FANGs. They find it hard to think beyond the Mag 7 and now more recently just NVIDIA, right? Investor experience over the last few years has been so extreme that there is a tendency to think that this will persist forever. I think that is the key point. And for us, it feels like short-term thinking. And we need to look at history, and that's what this chart is trying to do. We need to look at history to fix that. So first you look at a slightly longer arc of history than just the last decade plus. So if you go back the last 50 years, which is what this graphic shows, and if you compare US returns to non-US returns, you see that there is nothing special about what's going on right now. You routinely go through long periods of US outperformance, followed by long periods of US underperformance. Now, if you move to the next slide, it's probably one of the most beautiful charts I've seen on this topic. This is an even bigger view, right? It's even wider view. We zoom out even wider, think about longer time periods. This chart goes back to 1900. It takes the global equity market as a whole and then splits it by country, right? It shows how that's evolved over the last century or so. And at different points, just focus on which country has the giant share of global market cap. Now, today, of course, it's the US. US equities dominate global markets. Everybody knows that. But as recently as 20, 30 years ago, the late 80s, early 90s, Japan was a big part of the global equity market. That was at the height of the Japanese equity bubble. In fact, during that bubble, you might have heard of the stat that Tokyo's Imperial Palace alone, just that building, was valued higher than the whole state of California. So put yourselves in the shoes of the Japanese investor of the late 80s. All they had seen is their home market outperform for such a long period. They would have been overweight their home country for sure. Now, 30 years hence, you see the headlines about the Japanese market finally getting to the same level, the Nikkei hitting the same peak as it did 30 years ago. Many have still not recovered from what's happened in their home market. Now, of course, we're not saying that this is going to happen in the US. The point we're making is that performance leadership can change over time and does. And there's no need to take for granted that the US is the only game in town. And if you think about it, it comes down to home country bias, which is, very well documented. The question is, how do you overcome home country bias? How to overcome home country bias, especially when your home country has done so well recently? And it's an important question because not doing and is essentially missing out on perhaps the only free lunch in finance.
Sure, Krishna, that brings up a good point. I think all of us can recognize, part of the reason why we think these companies are so great, like Amazon, when we get packages that show up at our door every day, and we're using our Apple phone every day, and we think, gosh, these are such great companies, and they are, and they've had such phenomenal returns. But is the U.S. the only place that great companies exist, or maybe are there some companies outside of the U.S. that are also great companies that the average person might not think of on a daily basis that they're fantastic companies?
No doubt. The US market has some terrific businesses. There's no doubt about that. And some of them have done extremely well recently. Now, they also happen to be heavily followed, right? With 50 plus analysts covering every movement, daily CNBC coverage. So really, I would flip that question around a little bit and say, if you can find good businesses that are outside the US, perhaps not as widely followed, creating generational wealth for investors over time, why would you not want to think about them? Why would you not want to own them and invest in them? So this next slide you see, this slide you see a few examples: Diageo, TSMC, Walmex, Richemont, companies with very, very strong franchises. Why would you not want to own them? Just we'll take the example of Diageo, right? The history of Diageo is pretty fascinating. As you all know, it's a quintessentially British company. I mean, you think Scotch, you think Diageo. They own the largest collection of Scotch whiskey brands. They are not a US company. The history there is fascinating because it's a 200, 300-year-old company, very local British company. In fact, you can trace the origins to all the way back to the 1750s with the J&B brand. And then Johnny Walker brand comes along only in 1820, which is like another 70 years later. And that itself is more than 200 years ago now. So very, very long time, very local British firm. But the firm keeps growing through all those changes. And as you can imagine how much has happened in that time, right? Despite all the changes in the world, the firm keeps investing in businesses and customers, not only in their home market, the UK, but around the world. Today, fast forward over 250 years, the share of business for Diageo that comes from the home market is only 6%. So it's a truly global spirits powerhouse listed as a UK company. Now, ask yourself, right? If the original founders had stuck to their home country bias, we probably wouldn't have heard of Diageo and its brands today. To me, that's a great story. It's a great example that generational wealth is created when you can think globally. Imagine during all those years, there would have been so many times where you could have easily said, the UK is the best market in the world. It's outperformed forever. Why even bother investing outside? So some of the best businesses are global. They got there by starting locally and then investing globally as opportunities came up. Many investors, I think, forget that and seem very hesitant to go outside their own shores. And I think today what's happening in the market, I find it fascinating. If you look at the next slide, the focus in the US is on a narrow sliver of stocks that everyone follows, right? Today, there's a complete lack of imagination in the way people invest in the US, especially ordinary retail investors, everyone piling up on a handful of US mega caps, 7 or 8 stocks, they account for most of the interest, most of the headlines. And these are the stocks that are followed by 1 million analysts every day. I think that herd behavior is the core of what makes international such a fabulous opportunity, because you have an abundance of high quality companies that get less interest. And if you're selective and can pick stocks, it becomes a great place to hunt. So the question really is, especially when we as investors have the resources to be better diversified globally, it is easy to do. Why would you not take advantage of that? And especially now, I think now is a great time to do this. Why? Because 2 reasons, right? One, allocations are probably lopsided, as we said. in favor of the US, given what's happened over the last decade. And two, and if you go to the next slide, you will see a slide on valuations. The fact that the US has outperformed for such a long while now, the flip side of that is that the opportunity is also better outside. Valuation differentials are more favorable on a like-for-like basis, and you're finding similar quality businesses at cheaper valuations compared to the US.
Matt, do we have you?
Yes. Sorry about that. So, Krishna, maybe turning to currency, because obviously investing outside of the U.S. Prevents some currency translation. Does currency offer up opportunities as well, and how do you think about currencies when investing outside of the U.S. Given that U.S. investors make money in dollar-denominated terms?
Yeah, that's true, Matt. What's happened with the higher rates in the US, you've definitely been seeing a stronger US dollar, right? And consequently, from our perspective, a nice discount in the key currency trading pairs, right? So if you think about the euro, the yen, the pound, you're getting a nice discount on those currencies because of the strong dollar. Now, this doesn't always occur, and it's hard to say how long these disparities will last. We are not currency experts, so we don't invest on the basis of currency. But I will say it this way: I mean, it's the kind of environment that is energizing for stock pickers like us, investors who are price conscious, because the currency gives us an additional discount. We like discounts, so we like to buy good businesses when they're on sale. And what we've been getting over the last couple of years is double discounts, right? The market is giving us two layers of discounts in international. One, equity valuations being lower than the US, and two, the key currency pairs trading at lows against the dollar. Now this happens from time to time. No one can say with certainty what the frequency of this is or how long this disparity will last. But think about it. For anyone with a long time horizon, the prudent thing to do would be to increase allocations to international during such periods. If you think about it, this is no different from choosing to vacation in London when the pound is cheap, right? And I think we have a couple of slides in here, maybe the next slide and the following slide, where you kind of further make this point. If you compare the growth projections outside the US, those are better. At the same time, if you look at the market valuations outside the US, those are more favorable as well. So that is the opportunity here.
Yeah, Krishna, quick question. I'll jump in here. Oftentimes we get from investors questions about recent performance of the U.S. dollar. So the U.S. dollar was strong somewhat last year, which matters to the U.S. investor. So do you think it'll continue to be strong like it was in the back half of 2023, or how could you see that changing in the future?
Matt, like I mentioned, it is we think it's an impossible question to answer. What we do is we match key currency pairs, and we have a long-term, more fundamental view on how to think about the currency pairs. But in the short term, anything is game, right? We are not in the business of predicting currency moves in the short term. And honestly, the answer is I don't know. And frankly, I don't think anybody does know that. The way we look at it, like I mentioned earlier, is anytime when the currency gives, as a long-term investor, anytime when the currency gives you an additional discount, an additional margin of safety in our investment, we take advantage of it. So when we think about, I personally think about allocations to international, I think that during this times of strong dollar, it is even more of an impetus for me to increase my allocations to international.
Great. Maybe let's switch over to kind of the opportunity set outside of the U.S. and what markets you're seeing for growth right now, and by region or by market. What looks interesting to you out there from a macro perspective?
It's a I guess a good segue to talk about, first of all, talk about why even the opportunity outside the US is more interesting, right? So if you move on to the slide after that. Yeah, I'll move one more slide. Yeah, perfect. So far, we've been talking about international in the aggregate, right? So we're talking about valuations in general, we're talking about the currency discount. If you drill down and you look at this slide, it tells you what we really are excited about. What we're excited about is the opportunity in individual businesses, because that's how we invest, right? So if we look at the slide, it lays out exactly why we're so excited. Because when you look at it just by market cap, which is the graphic on the left, you have about 40% of the market cap outside the US. And these numbers change a little bit, but you can see that US is significant. As an investor, you look at the 40% and you know that it's too big to ignore. But then look at it slightly differently, right? Look at it not in terms of market cap, but in terms of the number of listed individual stocks with which you can build a portfolio, with which you can generate alpha by picking stocks. That number is lopsided in favor of non-US, as you can see on the right? We generate alpha from picking stocks. We manage risk by picking stocks. So where can we find the most number of stocks? It's clearly non-US. Now ask yourself, right? If you're looking for alpha over the long term, do you hunt in this diverse pool of 80% of the total, or do you limit yourself to the smaller pool in the US? And it also happens to be the place where companies are very well researched, many are on CNBC every day, less likely to be mispriced. So this opportunity set in terms of number of listed companies and the mispricing from lack of investor attention, that's what gets us interested in international markets. And later in the presentation, we can talk a little bit about the markets that we're looking at and maybe expand on that. Back to you, Matt.
Sure. So maybe that's a good segue into kind of what markets are we thinking about right now, and from a growth perspective, and maybe opportunity from a valuation perspective. Maybe we go into that right now.
Sure. So it is a mixed bag, I would say, and if I just look at the last year or so, our team has been out traveling: Japan, India, Mexico, Brazil, France, the UK, Nordics, meeting with management teams, visiting factories, stores, depots. So I guess the simple summary of this is there is no clear theme on one place where we're finding ideas. We're finding ideas all over the world, right? Japan, we'll talk about, in fact, the idea that we profiled to talk about today is a Japanese name. India is a market teeming with listed companies. We're finding ideas in Mexico. Brazil, rest of Latin America, a lot of markets in Europe, all seem interesting to us. It's probably the right time for me to also mention that travel is an important part of the search process for us. So maybe I will talk a little bit about what travel gives us. What travel gives us is the ability to frame an investment in the correct local context. So we're spending a lot of time in these markets trying to understand what is mispriced and what is changing as well, which is another theme that you will find.
Sure. We had a question come in from the audience about geopolitics. I think all of us hear the news every day, and it seems like geopolitical risk is at a high for the recent history. How do you and the team think about geopolitics when you're analyzing investments?
Yeah, that definitely is a very topical question. It's certainly when we look at an example later today, we'll talk about geopolitical risk and how we look at it. Let me start by saying this, right? If one is skeptical of geopolitical factors, whether it's conflict related to China, in the Eurozone, Middle East, I would say it makes no sense to have just a passive allocation to international benchmarks. It is the biggest reason why we think you have to be selective in this market. So I'll give just my personal example from Diamond Hill. This is our 8th year running the international strategy at Diamond Hill, and we've seen our share, right? Just in these 8 years, if you go back from Brexit, trade wars, COVID, followed by vaccine and recovery, multiple markets going back into shutdown, back to reopening, inflation, central banks tightening, 2 wars ongoing, an entire country, Russia, disappearing from capital markets. I mean, you name it, and we've seen it, right? Every point in time, there were and there are many big, difficult geopolitical questions that are being asked. But think about what's important. During all the time, if you're a stock picker in international markets, you made money investing, right? So the geopolitical environment is sort of the canvas in which we operate. It actually presents opportunity. It is the reason you want to own a carefully curated portfolio rather than a benchmark. I mean, if you're worried about macro, why would you ever own an international index product, right? Which gives you a piece of so many mediocre businesses. When you can be selective and own just the best opportunities, companies that you know can thrive in a range of outcomes for the world. So that's how we think about geopolitics. It is an opportunity, and it defines how we attack the non-US stocks.
I think at the cross section of geopolitics and economic growth, we recently had the Chinese central government come out and make their growth projection for this year, and it spurred a question from the audience that I think is a good one that is probably on many people's minds. What are your thoughts on China right now? Are you investing there, and just any insight from that perspective?
Yeah, China is hard. Why is it hard, right? Are there really good companies that have strong franchises? Yeah, there are. There are many well-run businesses in China with significantly strong franchises. Are they trading cheaply? Absolutely, right? It's one of the cheapest markets today, and many of these companies are demonstrably cheap on any metric. But I say it's hard. Why do I say it's hard? Because you don't know if these companies are run for the equity holder or for the Chinese government. That's super important, because you can come up with a forecast, you can come up with a discounted cash flow model, but are those cash flows eventually going to go to the equity holder? Many of these companies generate prodigious amounts of cash flows to equity, but you have to keep asking at what factor would I discount them? Are they really cash flows to equity, or can they be taken away? So very smart, rational investors can debate this, right? What is the right cash flows to model, and what's the right discount rate to use? And what appears cheap, is it really cheap? So from our perspective, we think the risks are significant enough that we have to be selective. The best we can do is be very mindful about our exposure to that market.
Sure. Maybe flipping ahead a couple slides. In international markets, you can have these big global companies like Diageo that you mentioned earlier, and you can have other types of companies that are more local kind of plays. How do you think about investing in the kind of the global kind of businesses versus the local, and how do you handle that?
Yeah, that's it's all opportunity, right? So the part of being selective in a canvas that is so wide is that we get to identify and own companies of all kinds. So in this slide, I think we had Unilever, which is obviously a global consumer products company. You see brands like Dove and Magnum, brands that are very well loved and in places as far apart as Brazil, India, and the US, right? So you have such a broad global company like that, and we mentioned Diageo. And then you have Walmex, which is Walmart de Mexico, which is the Mexican grocery chain, the Mexican version of Walmart. It operates in Latin America, but mostly in Mexico. Very, very high quality business, very local, right? And the key point is you have opportunities to own local gems. You also have opportunities to own really global companies because you have access to so many different markets and you can be selective.
Sure. Specific to Walmex, there's an election this year in Mexico, as there is here in the U.S., and quite frankly, a big portion of the world population is under it's an election year for. So how do you think about that from an investment perspective when you're considering a company like Walmex, the fact that there's an election this year and the potential outcomes from that and how it could impact the business?
Yeah, we always say bad headlines is where we find the best investment ideas. Mexico's in an interesting spot, right? It's getting ready for elections this June. That's usually when you expect, big political headlines, regulatory noise, and in general, government intervention into business tends to be high during those points of transition. And you're seeing that, right? Throughout last year, we've seen in Mexico several actions from the government and the regulator going after some businesses. As an example, I think it was in Q4 last year, the Mexican airport operators were impacted overnight, right? The government overnight proposed a significant change to the way tariffs are calculated for the airports. Those contracts have been in place, I think, since the 90s. So it was a drastic change done overnight, unilaterally, right? That was a shock. It was a shock to almost everybody. The stocks opened up the following day down 30% one day. Those are the kind of situations we think when we can find really high quality businesses at valuations that we like. So Walmex was somewhere around that time frame was when we were able to initiate a position in Walmex. Walmex is a very, very high quality company, one which had always been too expensive for us, one which we had admired from a distance, but never getting the chance to buy. Last year, sure enough, there was regulatory scrutiny on the company, and for the first time, we were able to buy it at a reasonable price, right? Now, I can tell you, to your question, the path from here might not be smooth for Walmex, but over a few years, right, we do quite well owning good businesses when you buy in bad times. So if you dig into the Walmex situation in particular, Walmex is the largest retailer in Mexico and Central America, right? So it has a dominant position. Over 60% of the grocery spend goes to Walmex. The biggest attraction for us was how good the company had been on capital allocation, meaning it had been so good at proactively investing in building stores and its online presence, its digital wallet functionality, essentially becoming embedded in the customer life, right, in Mexico. And it's able to earn a very, very high return on invested capital. In fact, it might be the highest number across all grocery retailers globally, right? The regulatory authority had been after Mexico for a few years on this, but ahead of the elections, they stepped up the scrutiny, talking about monopolistic practices in some markets, which is where the stock got attractive. We really think that case would not amount to much. Walmex is dominant in these markets, but it's dominant not because of some M&A or aggressive cornering of the market. It's dominant simply because it's the only one that's bothered to invest in some of the rural parts of Mexico. So it's an interesting situation. We like the thesis, but we'll have to wait and see how these things play out over time.
The Mag 7 has been the talk here in the U.S. for a couple of years now. Have there been sectors or industries outside of the U.S. that you've seen really strong performance as well over the last couple of years?
Yeah, nothing comparable to what you're seeing in the U.S. There's been pockets around semis, pockets around technology, pockets around healthcare, especially to do with diabetes and weight loss. There have been a few exceptional growth stories, but it is nothing like what you're seeing in the US market. So it is still a very, very broad market. What I would say is the market is a little bit more concentrated when you go outside in lower quality businesses, right? So in many of the markets, you will find the benchmarks dominated by state-owned companies, companies which are in some cases very much just a proxy for the government. So in terms of the quality of the benchmark outside, I would say the quality is poor, but nothing similar to what's happening in the US.
Sure, and we had a question come in, kind of about the benchmark composition in international relative to the U.S. And the question was, can you talk about maybe the different growth profiles of some of the sectors and how that relates to kind of valuations and an international benchmark relative to the U.S.?
Yeah, let me start by saying this, right? We are bottom-up stock pickers. So what we are looking for is individual equities where we find that there is a big mispricing between what we think the intrinsic value of a business is and what it's trading at. We don't invest at a benchmark level. In fact, half the time we ignore what the benchmark says. And I think I made this point earlier. The international benchmarks are extremely poor in terms of construction. So when you look at an international index, it doesn't really correlate to the amount of economic activity that happens ex-US or correlate to individual market growth rates. So we don't essentially get down to the level of thinking about the benchmark in that manner.
Sure. Yeah, maybe just transitioning. You mentioned that you should be selective when you're investing internationally. How do you go from that huge stock universe that you showed a couple slides ago to a much smaller portfolio, at least from a number of names perspective? How do you go about being selective and maybe provide an example of as to kind of how that output what that output becomes?
I think we should start with the philosophy, right? Because the philosophy sets the tone for everything we do. Every strategy in Diamond Hill shares the same intrinsic value philosophy. Now, what do I mean by that? We don't think of this as buying and selling securities. We think of it as being owners in a business. So if you think like an owner, what will you do? You'll first make sure it's a good business. You'll make sure that the long-term outlook of the business is favorable. You would want it to be run by capable people with a track record you can understand. And you'd want to buy it at a discount, right? You wouldn't want to overpay for it. That is the core philosophy, right? And I start with that because that is important. That then sets the tone for how we think about constructing a portfolio. It sets the tone for what our process is. So it makes the process very research-driven. We want to know what we own. So we, as analysts, are spending most of our time trying to understand the businesses and how their prospects are changing, hunting for opportunities that are misunderstood. What does it mean from a portfolio perspective? Once we find good businesses at a discount, we want to buy and hold them patiently over time because they compound, right? So the portfolio tends to be A, very differentiated from any benchmark, and B, generally low turnover because we want to be patient with our ownership. So what you end up with is a very carefully curated portfolio, very selective. We own 40 to 50 stocks. By definition, it's a very small sliver of what's available in international markets. And I want to stress the word selective because we start with the recognition that the international benchmark is bad. You've got mediocre companies, history of bad capital allocation, many are state-owned, many financial institutions that are simply a proxy for the state, resource companies with a long history of the state telling them what to do. So the process for us really starts by saying no to many of these things. And that is our problem with an index fund approach, is that why would you want a piece of all of this, right? You want to own the best ideas, ignore the rest. Perhaps if you move to the next slide, I'll talk a little bit about an example, Mitsubishi Corporation, and that'll kind of highlight how we think. So Mitsubishi Corporation is one of the Japanese trading houses. Most of us have heard of the Mitsubishi name, especially in the context of cars and electronics. These are actually a family of companies, right, that bear the same name. And Mitsubishi Corporation is one of them. It is, I'd say it is an amazingly complex company. They have ownership interests in a range of industries. So everything from metallurgical coal in Australia, copper mines in Chile and Peru, salmon farming in Norway, convenience stores in Japan, auto distribution in the Southeast Philippines and Thailand. So if we dig into this business in detail, it's going to be its own webinar. So I'm going to focus on a few things, right? I'm going to focus on why this is interesting. And I'm going to focus on why we think there is a misunderstanding, just to give a flavor of how we think and how we put together a selective portfolio from specific investments. I'll start with the broad thesis, right? You have and you see some of these bullet points. Basically, you have a well-managed business, strong global presence, deep talent pool, very diversified, ultra-conservative balance sheet, and finally, here's the important part: you're finding them at a point when they're rapidly improving capital allocation. They're keenly focused on shareholder returns, right? You have all of this, and you have a chance to buy that at an attractive price. That's the thesis. So we're thinking about the business, we're thinking about the balance sheet, we're thinking about the management, we're thinking about capital allocation, and we're thinking about an attractive price, right? Few interesting things here, right? Why are we finding this idea, and why is the market missing this, right? We have to ask this question: how are you differentiated in your view? First off, right, it's fascinating that not many investors know this very well. I mean, you have a huge company, $130 billion in enterprise value, $150 billion in revenues just last year, super global, right? They have their hands on so many different aspects of global GDP. Long history, right? Going back to the late 1800s, very prestigious in Japan, still, I think, a number one or number two preferred employer, depending on the year. Long tradition of excellence there. But despite all that, it's not that widely followed, right? Not much is available in the public domain if you search up Mitsubishi Corp. So that's the first point, right? There is market apathy on the name. Second, complexity. I mean, it is a complex business, and the typical analyst would get lost in the weeds and won't be able to summarize it in a simple theme. It's not a simple pure play that that can fit the latest soundbite, right? Whether it's AI or weight loss drugs or anything else like that can sport a high valuation. So that's your second source of opportunity, the complexity. The third here, again, this is interesting and differentiated, is the idea of focusing on actions over words, right? A lot of the US CEOs, especially Western CEOs, are talkers, right? They're extremely good at playing to the stands. Any average investor coming out of a CEO meeting is not going to be disappointed, right? Most CEOs know exactly what you want to hear and are experts at articulating that right message, the right framing for your ears. With Mitsubishi, you're not getting that, right? It's the opposite. You get numbers they report, metrics that they track, and straight, fairly boring statements about what exactly is going on. And if you think about the actions that they've done just recently, I mentioned capital allocation, the number of businesses that they've divested, the number of non-core stakes that they've reduced, the amount of capital in terms of dividends and buybacks that they've returned, just in the last couple of years, it's an impressive amount, right? Impressive amount of change in capital allocation in a short period for a company with such a long history. Now, imagine if any other Western company did all that. The amount of headlines that you'll get, the amount of self-selling, I guess, you will get. With Mitsubishi, you don't get any of that, right? And part of it, I think, comes from the fact that, like most Japanese companies, there is less of a star CEO culture. There's no fuss. No one is trying to get to the cover of Fortune 500. It's more of a patient, long-term collective culture. Our big learning, and this is the third source of opportunity, is when you see actions without the talk and you learn to recognize it, you will find some gems like this, right? And I'll add one more final thing, which is a little bit broader, and we think it's the fourth source of opportunity here, is with international, when you analyze a business, it's very important to understand not just the cultural dynamic, but also how that dynamic is changing, right? So in corporate Japan, Japan Inc., if you will, change has to come from within. It has to have a collectivist flavor to it. It's a collectivist culture, and asking for change in the name of shareholder returns and stock price going up is not going to work, right? So over the last 20 years in Japan, you've seen repeatedly Western investors trying to play an activist role. And for the most part, the results have been poor because an outsider telling Japanese management to change, and with the logic of increasing share price performance, it was exactly the opposite trigger of what was going to succeed in corporate Japan. What you need instead is gradual change, but from within, right? And the cost needs to be articulated as a positive for the Japanese society, not just increasing share price, right? So if you follow this market over the last 10 years, right, you can gradually track what's happened, right? In 2013, Abe's structural reform arrow. 2014, you had this document called the Ito Review. That document, for the first time, had the statement. It was provocative. It said, increasing capital efficiency in the broader sense is crucial from the perspective of Japan's survival. So think about it. You had this document, which is essentially a document on corporate culture, telling every firm in Japan that improving capital efficiency is the right thing to do for Japan as a whole, right? From then on, it's taken a lot of time till last year, when now you're finding a situation where even the Tokyo Stock Exchange is publicly naming and shaming companies, playing to peer pressure, and forcing these companies to become good corporate citizens by improving their balance sheet, right? Now, I think this is a great source of opportunity, understanding cultural change in places like this, and if you can have the patience and the humility to appreciate this change, right? Instead of following sort of a Western mindset, you can find opportunities. And frankly, for us, I would say that is the fun part of this job, is understanding the cultural nuances of the different countries in which we operate.
Sure. A question from the audience that I'm sure many people in the audience can identify with. The question is there a way to get exposure to AI outside of the U.S., so similar to how you get exposure to NVIDIA within the U.S., as I'm sure many advisors have gotten calls from their clients recently wanting to know if they have exposure to NVIDIA and all the talk about AI here in the U.S. Is there a way to get exposure to that theme outside of the U.S.?
For sure. I'll keep the answer simple, right? TSMC really is the foundry to the world. We own TSMC as a top position. Simply, you don't make NVIDIA chips without TSMC. So that's one. Samsung, right? Samsung is one of our top positions. The dramatic increase in computing that you're seeing at the same time is also driving demand for high bandwidth memory. And guess who has almost half the market share in memory? It's Samsung. So TSMC and Samsung, I think, are sort of unspoken background heroes in this AI game. Both these positions are available for really cheap multiples, especially if you compare to what you're paying for NVIDIA today, which means we get to participate in the AI boom at a huge discount to what you would be paying for in US stocks.
Another question that came in looks like from someone who knows Diamond Hill a little bit, and they ask, I know Diamond Hill as a value shop. From a peer relative perspective, should we compare your international fund to other value managers or blend core managers?
The approach, I think I speak for all of Diamond Hill, is that our approach is intrinsic value. The way I explain intrinsic value, it's about wanting to pay less than what we think a business is worth. We don't define value just based on simple PE, price to book, low PE or low price to book measures. So I would think of us as an intrinsic value strategy. I don't think there are times where we would own stocks which you would technically classify as value. There are times we'll own stocks that technically classify as growth, and other times the stocks will be blend. And the most interesting thing is sometimes we've owned stocks, and I mentioned we have a very long time horizon. We've owned stocks throughout our 8-year period, and the stocks have become value and growth and blend and keep changing over time. But throughout that time, the stock keeps compounding and our estimates of intrinsic values keep going up and we keep owning the name. So we don't try to think of it as simply following a bucket or using some kind of numerical way to think about what's interesting.
Great. Well, thanks, Krishna, and thank you to everyone for tuning in today, and thank you, Verify, for having us. This concludes the presentation.
Thank you all.
I want to, great, just really quick, I want to remind everybody that if you check your email inboxes very shortly, you're going to get a copy of this presentation and the on-demand version of this presentation. You're going to get an email notifying you when that goes live. And if we didn't get to your question, don't worry, someone from Diamond Hill will personally get back to you after the broadcast. So thank you everyone so much for attending today's webcast. It's a very special thank you to my guests, Krishna and Matt, for joining me today. And thank you again, and we will see you next time.